Right. All right. So we have four modules to go through tonight. Fair amount of content. I'll try and keep it as succinct as possible. I kind of got a little rambled on a little bit on Tuesday, so I'll try and make this a little more cut and dry. So now, presuming we're at a point where if you're doing the return, all the income sources have been input, all the adjustments have been made, and now we're ready to uh, get down to what else we can do with the return. So in this one, we're going to be talking about how the final tax liability is calculated. And there's various ways to lower both the taxable income and then the actual income that's calculated off of that. Difference between standard and itemized deduction. Again, which deduction will be used and what specific items we should be looking for on the off chance that we will itemize. So remember, you're not taxed on all of your income. Income that is considered taxable must be reported on the 1040, but that doesn't mean that all the income will actually be taxed. So just so you know, the total income does not equal taxable income. There's a difference between the two. So total income minus adjustments, which is what we're doing last week, gets you adjusted gross income. Now we're starting with adjusted gross income minus the deduction gets us to taxable income. So again, all the income that's taxable that we see, wages, interest, dividends, cap gains, personal income, business income, pensions, Social Security, unemployment, etc. So now, remember, the types of adjustments that we generally see in VITA are things like student loan interest, the teacher expenses, maybe alimony, very rarely an IRA deduction. And now we get into the standard and itemized deductions, okay, that will get us to the taxable income figure. So again, deductions are subtracted from adjusted gross, which results in taxable income. And then taxable income is what is multiplied by the tax rate to get the actual tax that's due. Okay, there are two types of deductions, the standard and the itemized. And in almost all instances at VITA, we see the standard deductions. So you don't have to worry about, which one they're gonna the taxpayer is going to use. Since almost nobody itemizes, they're always going to get a standard deduction. So this little flow chart here, we're at AGI. If we do start to itemize, because maybe they think they might have enough to itemize, again, so once you get to the sum of itemized, if it's more than standard, the software will automatically assign it the taxable income. Again, the standard deduction is a dollar amount that reduces the amount of taxable income. Varies according to your filing status. There can be additional money taken as a standard deduction if you're over 65 or blind. Again, if you do itemize, you can't take the standard. And generally, if you can qualify for someone else as someone else's dependent, you can't take the full standard deduction. These are the three standard deductions for 2024. So single and married filing separately, it's 14,006. Married filing jointly, and or the qualifying widower is 29,200, and head of household is 21,900. So if you're 65 or over and or blind, you get $1,500 each for each taxpayer. So a husband and wife who have to be over 65 and they're both blind, that's $6,000 extra. Again, head of household, if you're filing over 65, you get 1850. Okay, an individual who qualifies as a dependent, the standard deduction is the greater of $1,200 if all the income is unearned income, or the sum of $400 and the individual's earned income. So itemized deductions, again, the first part is really the key thing here. The current law and since it seems like what happened on Tuesday, we're probably going to continue with the standard deductions set up like we have for the last 8 years or thereabouts. Most clients will find that their income is they're better off using the standard deduction. Again, very rarely someone, if they have high mortgage interest rates, then they might qualify. Um, Again, we're only talking about federal returns. Many states, you don't have to worry about any of this. For New Jersey, do have to worry about a few things, and we'll get into that here. So again, generally itemized expenses include medical and dental expenses that are out of pocket. Your taxes paid, the sum of state and any local income taxes, as well as your property taxes, which is currently maxed at $10,000. The home interest and points, gifts to charity, some other miscellaneous things, which we don't really see a lot. Again, medical can be helpful if and when it exceeds 7.5% of the adjusted gross income. Now, this can include out-of-pocket doctor, dental bills, prescriptions, hospital bills, insurance premiums, both out-of-pocket health care coverage and long-term care. Any policy that's not subsidized by the Affordable Care Act, which we'll get into at the end of the session. Mental health treatments, mileage to the treatment center, et cetera, et cetera, et cetera. Um, Again, state and local income taxes, any local foreign income taxes, real estate taxes, personal property taxes, which we don't really deal with in New Jersey. And again, since 2018, your property tax is limited to $10,000. Now, most of our clients live in the Trenton, Ewing, parts of Lawrenceville, and a lot in Hamilton. So it generally they get to take the full amount of their property tax. We don't have a lot of clients who live in the, Princeton, West Windsor, Hopewell, where taxes are well over $10,000. And let's see here. So one thing that okay, so itemized deductions, we include the uh, first and second home mortgage, primary mortgage, private mortgage insurance. Reverse mortgages, we do see a few of those. No interest until the loan is settled. We do, a lot of people still come in with, an envelope full of receipts about, charitable donations. Um, Again, that is generally not of any use anymore because of the higher standard deduction. We may see some gambling losses, or we do see, quite a bit of gambling winnings. And almost in all cases, the gambling winnings or gambling losses are equal to or greater than the actual winnings. So those can go on the Schedule A. But again, if they're not if they don't have enough of other stuff, chances are they're not going to be able to write that off. Again, with 2018, a lot of the miscellaneous stuff that would go on Schedule A, union dues, investment expenses, unreimbursed employee business expenses, uh, are no longer deductible. Um, there's some other items, casualty theft losses, that's out of reach for VITA. So again, taxable income is not equal to total income. Total income minus the adjustments is adjusted gross, and then adjusted gross minus one of the deductions, either standard or itemized, equals taxable income. So again, the software will always choose the lesser of the two. I mean, excuse me, the greater of the two. So you don't have to worry about that. In almost all instances, we um, we will be doing the standard deductions. Now, the thing to focus on one thing real quick here. Um, Even though people don't itemize, there are a few things in New Jersey that do require us to potentially put in things like for medical expenses. The reason there is the threshold is 2% of income that you can deduct that'll actually help you. So even people who have good medical coverage or particularly dental, um, dental could definitely be $1,000 for a crown could very easily be out of pocket. And that generally will help people a little bit, get a few dollars back. And the same thing with taxes paid. You get the full credit of that. For New Jersey, and either depending on what your income is, you'll get somewhat of an adjustment, or if you have no taxable income and you're over 65, you'll get a $50 rebate from the state of New Jersey. Again, we don't. Most of our clients are renters, so we get their rental income, which then is calculated. So if they could pay $10,000 a year in rent, we take 18% of that, which the software calculates. So $1,800 qualifies as a property tax deduction, even though they didn't actually pay property taxes, it was included in their rent. Okay, so now we're going to move on to um, non-refundable credits. Okay, so now we've gotten the whole tax computation, and now we want to reduce that tax amount, the tax owed. So again, these are the main non-refundable credits that we see: the child tax credit, the credit for other dependents, the credit for child and dependent care expenses, the retirement savings credit, credit for the elderly and disabled, and a few other ones which we'll get to, mostly EV credits. So a non-refundable credit is a dollar for dollar reduction of the tax liability. So all that can do is reduce your tax liability to zero. You can't go below zero. Anything that again, any credit that's not used is just not it doesn't carry over. You just lose it. Okay. Many of our clients would qualify for non-refundable credits, but in reality, they have no taxable income, so no tax owed, so no impact on their return. Um, Again, generally, the credits are applied against the federal income tax in the order they are listed on Form 1040 and Schedule 3, which we'll look at when we start doing some returns. So here's an example. Chris, when it's all said and done, his tax obligation is $400. He meets the eligibility requirements to claim a $500 credit for our other dependent. The total amount of non-refundable credit of 500 exceeds his tax of 400, so he owes nothing. Again, that 100 that's unused just goes off to non-refundable tax credit heaven. So the first one is the child tax credit. All right, child tax credit is non-refundable. The max is $2,000 per qualifying child. Um, Again, taxpayers who don't have a tax liability or don't use all of it may actually qualify for the additional child tax credit, which we'll cover in the next module. Once all the data is put in for the children, TaxWise will indicate will create a form 8812, and this is going to calculate some things about eligible children and things that we have to do some due diligence on. We'll go through that when we get there. Again, this is a common credit. It can also be claimed by parents that have an ITIN as well. All right, so the qualifying child. Um, Oh, well, the requirements for a qualifying child. Again, they must be under 17 at the end of the tax year, so 16 and under. So if they turn 17 in 2024, they're not going to get the child tax credit. The child, a U.S. citizen, a U.S. national, resident alien, meets the relationship test, which we've talked about before, claimed as a dependent by the taxpayer, did not provide over half of their own support, which obviously very easy because generally they're children, and live with the taxpayer for more than 6 months of the year and have a valid Social Security number. Now, there are special rules with divorce and separated parents. Generally, we hope that is worked out in the various custody issues that, mom can claim the children on the even years and dad can on the odd years, something like that. So again, just like we talked about before, as far as claiming a dependent, again, they must be related to the taxpayer in one of these ways: son or daughter, adopted, stepchild, eligible foster child, brother or sister, stepbrother, sister, or decedent of any of those listed above, like a grandchild, niece, or nephew. So this is a little screen, little slide that shows the changes in the makeup or the calculations for the child tax credit in 2021, which was, again, this was a big jump due to COVID. And what you'll notice there is that there was no earned income requirement. So if you just came in and you didn't work and you had two kids, you get the max credit. That went away in 2022 and as well as 2023, although the credit went up $100. The problem there is that, again, it was a big help to alleviating child prop poverty, but Congress did not renew that, and we're basically back to the way things were in 2020 as far as the child tax credit. Credit for other dependents. Okay, this is non-refundable, and the max is $500 per qualifying dependent. Again, the credit can't be claimed for the dependent that is a qualifying child for the child tax credit. So you get one or the other. Again, could be a qualifying child or a qualifying relative. The dependent can have either a social or an ITIN. The parents of an ITIN holder can also claim the credit. Dependent must be a U.S. citizen, national, or resident of the United States. Um, this is generally something we see for children in the home who are 17 and older. So 17, 18, 19 could be, still living at home, not in college yet. That's the frequent, growth of that. So here's Francine, age 43. She's divorced, earned 43,000. She supports her widowed mother-in-law, Connie, whose only income is Social Security. She has sons Henry, 16, and Neil, 12. And Connie, the mother-in-law, lived with them all year in Chicago. Her sons don't provide any of their own support, which makes sense. Everybody has a social except Francine and Henry, who have ITINs. So who can she claim for the credit for the dependents? Again, Francine is a qualifying relative, so she qualifies. Um, Connie qualifies for Francine because she's a relative. Henry is because he does not have a child tax, a social, but he's 16. Okay. Um, and Neil, no. Okay. He's only 12 and has a social, so he would be the qualifying child for the child tax credit. Again, it gets a little confusing, but the software will pick up when we input all the details for all the dependents, whether they have an ITIN, a social, and their birth dates, and whether or not they lived with the taxpayer for more than 6 months. So that all will, once all that's in, different fields will get active and they will do the calculation for us. Credit for child and dependent care expenses. We don't see this a lot. Again, this is a non-refundable credit that allows taxpayers to reduce income tax by a percentage of their total child and dependent care expenses. Okay, the max that they can claim is $3,000 for one child, $6,000 for two, and they don't need to be allocated the same to each child. It's just an additive amount. The child must be under 13, so the thought there is those older than that should be taking care of themselves. It could be a spouse who is unable to provide self-care or any other dependent who cannot provide self-care. You can't include any amounts that are paid to a person you can claim as a dependent or your own child who is under 19, even if you can claim them as a dependent. Um, Again, the idea is there is you don't pay one of your own to take care of a young child. So these are the five tests to get the credit. Qualifying person, the earned income. Again, the earned income is very generous, so that's generally not a problem with us. And it must be work-related expense. So in other words, the children are in daycare or after-school care because mom or dad are working late. This isn't so that dad can go to the gym, or same things during like summer camp will count as well. Again, provided that's because mom's working. Again, married taxpayers must file a joint return. So again, married filing separately is not going to be qualified for that. And again, you must provide the tax ID and the physical address for the location where the children are being cared for. If that happens to be a person, you need their social security number because you're reporting the expense. They should be reporting the income. It's gotta match. So here is Chantil. She's single. She works full time as a clerk. She has two children, Alex and Ashley. Alex is 3 years old and attends daycare while she works. Ashley is 7 and stays in after school care until she finishes work. Excuse me. For the tax year, she pays $7,200 to Bright Beginnings for Alex and 1,800 to Smith Elementary for Ashley to attend school. What's the amount of the maximum expenses? Maximum is 6 because although the total number adds up to $9,000, they can do 6,000 to each, even though that's how the credit's calculated. So credit for the elderly or the disabled, we don't see this very often. We don't see a whole lot of the child care credit either. Again, that's money people are paying out of pocket for child care. So a lot of them, it's that's a big burden. Don't see it very often, and occasionally people will come in and indicate that they paid a relative, but again, if the relative's not going to report the income, you can't take the credit for the expense. Um, the credit for the elderly and disabled is a non-refundable tax credit that reduces the tax burden on individuals who are over 65 or on total or permanent disability. Once we get rolling in one of these, it may or may not throw up a Schedule R, which can be a little complicated. And actually, I have not done a Schedule R in probably 5 or 6 years, so I'm just kind of go through some of the issues here. Again, the taxpayer must be a U.S. citizen, age 65 or older, under 65, and all of the three must be true. Retired on permanent and total disability, receive taxable disability income, and on the 1st of 2024 had not reached the mandatory retirement age. Um, the taxpayer must have income below certain AGI levels. Um, and yeah, if they're filing married separate, they can't get this credit. All right, now this is one that we actually see a little bit of, retirement savings credit, and this is why it's important to really enter everything off of the W-2 correctly, because that's where this is going to get generated. It's a non-refundable credit to encourage workers to voluntarily contribute to their retirement accounts. And it's also known as the Saver credit. You have up until the due date of the tax return, so it'll be April 15th of 2025, to make contributions to a qualified retirement account and qualify for the credit. Again, you have to fill out Form 8880, which pretty much populates itself once you indicate through a payroll deduction that you made the contribution. You have to be older than 18, not a student, and not claimed as a dependent on another person's tax return. Again, there are AGI issues. And here they are. Qualified retirement contributions of up to $2,000 may qualify the taxpayer for a credit of up to $1,000. Again, up to twice that if they're married filing jointly. Again, it's based on a percentage of their AGI. Distribution from retirement account during the past 3 years reduced the amount of qualified contributions used to compute the credit. Again, that gets a little more complicated, which we don't really see. These are generally going to be payroll deductions that you'll see on the W-2 right there. Usually in box 12B, there'll be a code there, and that's why it's important to get that correct. Like all these boxes, 12A, B, C, and D, there could be a variety of different things. Savers credit, we want to make sure we get as part also the HSA contribution. There could be things there like a code double D, which is the employer's contribution for healthcare, and a couple of other odds and ends. Again, the plan could be a traditional IRA, a Roth, 401, 403B if you work for the government or it's a nonprofit. Again, this is just a quick one. A single filer with $20,000 of AGI made $1,000 contribution. 50% of that is a $500 non-refundable credit. You can see the other two examples that uses because of the income that the credit is reduced by a percentage. So there's two other credits that are out there. I mean, we will not be seeing, I'm pretty sure, any credit for EVs, but that's a big part of the Inflation Reduction Act. The efficient home energy credit, we do see a fair amount of these occasionally. Up to it's not now it's 1,200, but usually that's the ones for the higher cost things. We see like people put in a new door or a new furnace, and that'll generally get them a $500 non-refundable credit. Okay, now we move on to refundable credits. Here we go. All right. This is the fun one. So again, there are three primary refundable credits: the earned income tax credit, the additional child tax credit, and the premium tax credit, which relates to people purchasing health insurance on the marketplace. So refundable tax credit is considered a payment made by the taxpayer. Refundable credits can reduce the tax liability to zero. So even after there's non-refundable credits, if there's still some there, the refundable credit will chip away at that first before it gets to be just a cash item. Taxpayers with no income tax who are eligible for refundable tax credits should file. Again, even if they're not required to for a variety of reasons, and I'll get to a few examples of that. So here's an example. Jeremy has federal tax due of $2,600. He can claim a $2,000 non-refundable child tax credit and a $1,500 earned income credit. The total amounts of $3,500 exceed the income tax liability of $2,600. So again, he's going to get $900, at least $900 refund. So taxpayers who cannot use the max non-refundable child tax credit may be able to claim the refundable ch additional child tax credit, and that's up to $2,000 per qualifying child as a non-refundable credit. Um, Again, the credit this year is now up to $1,600 per qualifying child. Again, it's similar qualifications as the child tax credit. Actually, it's the same. So if you qualify for one, you're going to qualify for the other. Again, to qualify, taxpayers must have more than $2,500 in earned income or have three or more qualifying children. Unfortunately, that last item is incorrect. We've had taxpayers come in um, who get this information as well. And in my conversation with the IRS, this part is not true. You do need $2,500 in earned income. And just so you know, the it's not you don't get the full $1,600 if you make $2,500. It's a scale. So where 3 years ago you'd get it all, even if you had no money, no earnings. Now it's all based on a formula, just like the earned income credit. So you may or may not get the taxpayer may or not get the full amount. Again, we'll be filling out Form 8812, and that pulls in some extra information on their income, the number of eligible children, um, and some other due diligence that we have to do that we'll go over when we do an actual return. So the earned income credit, income tax credit, it's a tax benefit that can serve as a financial supplement for taxpayers with lower moderate incomes, particularly those individuals with children. Um, this has generally been this credit's been, I think it goes back to the Eisenhower administration, and it has in general had bipartisan support in Congress. Um, there's been talk trying to expand that several times, and it doesn't really go anywhere, but it's still there. Again, there's two things that calculate the credit, your income and the actual family size. Um, Once you indicate that you're qualifying for the EIC, there will be a table to fill out some due diligence stuff, uh, and will indicate whether or not the children are eligible or not, or the dependents are eligible. So these are the max credits for this year. So if you're single, with no children, it's 632, 4,213 with one child, 6,960 with two, and 7,830 with three. Okay, how do you qualify? First of all, you must have earned income. Again, all you had was unemployment or Social Security or a pension. That's not going to do it. You have to have been a citizen of the U.S. for the duration of the tax year. You must have a Social Security number for yourself, your spouse, and any qualifying children. Again, these are all socials for this one. If there's any ITINs involved, you're not going to get it. Investment income cannot exceed 11,600. That's usually something we'll never have to worry about. The taxpayer can't be filing separately unless they lived apart for the last 6 months and there's a qualifying child. Okay, they can't file a 2555, which is foreign income. Again, if there's no qualifying children, the taxpayer must be at least 25, but less than 65. So during COVID, that actually went away. So a fair number of our seniors, and generally these are folks that work part-time. Maybe they drive a school bus or they do some nursing, home health aid, something like that. And that actually was a nice conversation. People weren't aware of that, but they got like an extra $600 that year, and then it went away. So Congress has not put that back in. The good news is there is an earned income credit in New Jersey. It's 40% of the federal, and the age exclusion does not apply in New Jersey. So if you made enough money to get the $632 uh, for federal, you're going to get a 40% of that for New Jersey. If you're 65, 66, you're going to get it as well, even though you're not, it's going to do the calculation, but it won't give you the federal earned income credit, but it will apply the New Jersey earned income credit. You can't be a dependent of another person. You can't be a qualifying child for another person. And you must have lived in the US for more than half a year, if no qualifying children. So here are the income brackets for EITC. Um, Again, generally, this is well within our target for folks. Again, the relationship for the qualifying child, again, same thing as before. No real change there. Again, filing at the end of the year, your child must be younger than you and younger than 19, or at the end of the year, be younger than you, younger than 24 and a full-time student. Um, or permanently and totally disabled. We see a fair amount of those. Child must have lived with you for more than half the year, and the child can't file a joint return for the tax return for the current tax year. All right, what qualifies as earned income? We talked about this kind of last week. Again, it's income you receive for work, which takes out things like interest, rental income, interest dividends, unemployment, workman's comp, and pensions that are not counted as earned income. So if you get a pension and you're disabled and you're under 65, that can be that can be counted as earned income for purposes of the earned income credit. Now, in that case, you're also going to pay tax on that. But again, generally, it's going to be the better situation. Again, earned income. So here's one here. This is kind of a tricky question. I'm not sure why this was put in the slide, but David and Daniela are married. They wish to file a joint return. They earned 58,050 in combined wages, and they sold $8,500 worth of telephone stock that they inherited to help purchase a vehicle. They have 8-year-old triplets. Would they receive the earned income credit? Well, their investment income, which again, the gross amount, okay, we're not talking about like what the taxable amount would be because we don't know what the cost basis of the telephone stock was, is 8,500, which is below $11,000. The problem is for them, their earned income when combined with their income gives them an AGI that exceeds the income limits required to claim EITC even with 3 kids. So there's this earned income and AGI, and you have to meet both tests. For our clients, that's generally always the case. There's not a difference between the two because there's not going to be these added income sources that are not that would push them maybe out of the adjusted gross income test. So I like to throw this in because this is a bell curve for how the earned income tax credit works, and you'll find that you're probably going to have these conversations during the tax year, where again the whole idea of earned income tax credit is to encourage people to work, but realizing that again, if they're a single parent or even if they're not, the expenses is can really hold them back, and the EITC is trying to make things a little bit easier. And you're not going to get rich on this, to say the least. But the dotted line is roughly the beginning, or roughly where what we call the sweet spot is. So in other words, if you make that money and that income, that earned income, that's where you're going to get the max credit. A little bit, less than that or more than that, the credit drops. And we'll see that as people are making more money, earning more, which is our data shows that the credits are going down, which is a good thing because they have that extra income that they've earned throughout the year. They're not just going to get that EITC check in March or April. Now, the problem is, okay, sometimes it could be a serious drop in earned income. For instance, maybe one of their children just aged out and did not go to college. So now they're not going to qualify for the earned income credit. That could drop off dramatically. Um, Again, there could be a death. There could be other issues that suddenly change the dynamic of the earned income. And it's ideally, we have 3 years worth of tax data for all our clients, and you can see that very clearly. And if they're not, let's just say they're a new client. They say, "Oh, last year I got $2,000 more." And well, it's always great if they have the tax return with them, but generally they don't. So in that case, it'd be like, well, what changed? Oh, I used to be able to claim my grandson, now his mother is, or something like that. So that's where time, and that's going to make a huge difference for people in our tax bracket. All right, here we have the premium tax credit. Again, this is the refundable credit that pertains to taxpayers who purchased health insurance through the Affordable Care Act, also known as Obamacare, although we don't try to use that term anymore. Again, you need to be advanced certified to prepare this. I encourage you all to get involved with our advanced topics later in November, early in December. Um, the insurance is purchased through either the insurance marketplace, healthcare.gov, or if you go to healthcare.gov and you indicate you're from New Jersey, it's going to redirect you to NJ Cares to buy it on the state exchange. And the way that works is like right now, this time of the year, people are arranging to pay to get insurance for 2025. And when tax time comes, you will get a 1095-A, which shows what you paid with the second lowest cost silver plan in our zip code area would cost, and the difference, the premium that the credit that the government gave you. That's all based on what you tell the marketplace your income is anticipated to be in the next year. Okay, so when we reconcile this in at tax time, that's just making sure we're trying to see that they got it right. If they overstated their income, okay, that could be, they could wind up getting better. They could be better off if they understate their income. So in other words, they're going to get a bigger credit, and suddenly, let's say they got a raise during the year, or for some reason they just really weren't thinking about what their income was going to be. That can create quite a bit of a situation that they're going to have to pay that credit back, um, and that can be a real issue. Um, Again, to qualify for the premium tax credit, okay, they must not be eligible for an employer-sponsored health coverage, which if they were, hopefully they took it, because generally it's always going to be cheaper than buying something through the exchange. Coverage through family members, employer-sponsored coverage, or government-provided coverage such as Medicare, TRICARE, or CHIP. Generally, our lower income folks are covered through Medicare and CHIP with the kids. Military is TRICARE for those that have not reached retirement age or age enough for Medicare. The taxpayer must purchase the health exchange from either the state-based exchange or the federal marketplace if you live in a state that doesn't have its own exchange. Now, the taxpayer's income must be between 100 and 400% of the federal poverty guideline amounts for that region and that family size. Now, we don't really know that. It's going to make some calculation when we do the reconciliation. And the problem is if you go to 401%, you may have to pay back all of the credit, and that can be thousands and thousands of dollars. And there's not a lot of ways to get out of it. The only real option you may have is to make an adjustment to your income, such as making an IRA contribution to try and get that taxable number down as much as possible. Very difficult to do because these are folks that by nature are not going to have $3,000 laying around to make an IRA contribution. So depending on what their income is and what the amount that the software calculates is what they may have to owe back. And remember, that part of the payment to the IRS will flow through to the insurance company. So if at the end of the day you owe $1,000 in premium tax credit, that will flow through the IRS as the gatekeeper, so to speak, and get sent on to Aetna or United Healthcare or Blue Cross or whoever. again, when they come in, they should have, again, part of the intake process is to ask them whether or not they purchased insurance through the marketplace. Um, Again, the 1095A that they have is going to show who's covered, the cost of the policy, the second lowest silver plan amount, and the amount of premium assistance that had already been paid, and the amounts and the months that were insured. That's important because, again, they've got to have that 1095. If they only, even if they only had insurance for 1 month, they've got to have it. Once we indicate that they had purchased insurance through the exchange, TaxWise will indicate, will populate a Form 8962, which is used to reconcile all this stuff. Then that will flow back to the 1040 with tax owed, or could be, could be even bigger credit. If they paid more than they thought they would, they're going to get some of that back. Okay. And now the final thing for tonight is tax benefits for education credits. Again, we don't see a lot of these. We did 2,100 tax returns this past year, and only 42 of them had a education credit. Again, we're going to determine who qualifies for the credit, which credit can be claimed, and the impact of scholarship or grant income. So education credits reduce the amount of tax due and are based on qualified education expenses that the taxpayer paid during the year. So there's two that we see: the American Opportunity Credit and the Lifetime Learning Credit. You can only take one of those. It's not, it's one or the other. It's not additive. The general rules that apply pretty much to both of them, but there are specifics to each one as well. All right, there are two ways that education expenses affect the tax return. The first one is something that we don't really see a lot of. That's the taxable scholarship or grant income. What this is if the student gets a large grant in excess of qualified education expenses like tuition and books, like a lot of students at Princeton do. Okay, Princeton is very, very generous with their financial aid, with very few strings attached. The point is anything substantially greater than the qualified expenses, tuition, books, fees, is taxable as income. A lot of people don't know that. Again, at the end of the day, would you rather pay 10, 12, 15% income tax on a big check that you got from Princeton or take out student loans? That's kind of how I word it to people the few times we actually have it. Now, a tax credit, again, this is a refundable credit you get for the American Opportunity Credit and Lifetime Learning. They're calculated on the return of the taxpayer who's qualified to claim the student. So mom and dad are claiming junior and he went to college. Full-time students under 24 claiming themselves as a dependent and claiming the American Opportunity Credit are only entitled to the non-refundable portion of it. Okay, I mean, this is a two-part credit. Okay, unless both parents are deceased. Okay, so generally, they're going to indicate that they had education expenses. Hopefully, they will have the 1098-T. The good news is most of that is just like unemployment is online. So if mom and dad don't have a physical copy, and some schools do not send them out, it's very easy to get that, log into the Bursar account, which I pretty much think if you're in college these days, you got to have access to that and or an account statement from the school. So, okay, an eligible institution is generally any accredited public, non-profit or private college, university, trade school, or other post-secondary institution that participates in the FAFSA. It's pretty straightforward. If you get a 1098, generally they're an eligible institution. The student, okay, is the taxpayer, spouse, or dependent who's enrolled in one or more courses that meet the requirements of the AOC or the LLC. And again, we'll get into some of the other details of that. Qualified expenses, there's a lot of verbiage here, but the important thing is that qualified expenses are tuition, fees that are required for enrollment, and course materials the student was required to buy from the school or bought somewhere else to satisfy the requirements. So in other words, buying books at the school bookstore or buying them online is it counts just the same. Other things that you could include in there, things like a laptop. The student is an art major, a lot of art supplies. All of that is uh, eligible. Um, Again, the big thing at the bottom, the one thing that it does not include is room and board, sporting event tickets, health insurance, transportation, parking fees, meals, all that stuff. None of that. That's like living expenses, basically. And that's where it can get tripped up. Like if the student um, has a large grant amount in excess of qualified expenses, it can create a problem. Okay. A scholarship grant or fellowship is tax-free only to the extent that it doesn't exceed qualified education expenses. It's pretty straightforward that way. I mean, the one thing that we'll see here is a sample tuition statement, a 1098T. Um, Again, these are what we see, and generally, um, again, all these to claim the credit, they cannot be claimed as a dependent on someone else's return. They must be the taxpayer, spouse, or dependent of the filer. Again, a dependent cannot file for the education credit. They're not married filing separate. Their AGI, it's actually a very high AGI target, so that's generally not a problem. They were not non-resident aliens for any part of the year. So qualified education expenses paid by the dependent or by a third party for that dependent are considered paid by the taxpayer who claimed that student as a dependent. And generally what that means is it's for the academic year, which straddles two tax years. So if junior graduated in May of 2024 and started college in August of 2024, he's going to get a 1098T that's going to have expenses for the fall semester and the spring semester. Again, that will all be claimed on that first tax return. Um, Again, so the flip side of that is in that they stay on a 4-year track. When they graduate in May, 4 years later, there won't be a 1098T to claim, okay, for the credit. So the American Opportunity Credit, okay, the student must attend an eligible institution, covers tuition, fees, books, supplies. 40% of the credit is refundable. Okay, the max credit is 2,500 per student based on $4,000 of qualifying expenses. So that's very easy to get to if you're going to any kind of state university. Um, uh, Community college, probably not going to be that issue. Um, so at 40% of that of the credit could be $1,000 non-refundable credit. Remember, you can only claim it for 4 years. You have to be enrolled at least half time. Um, and must be enrolled for at least one term. No felony drug conviction, and if you can't be filing married separate, again, only if they have not completed the first 4 years of post-secondary education before the tax year. So if for some reason they did not or could not claim the credit when they were an undergraduate and now they're in graduate school, the American Opportunity Credit does not apply because they've already achieved their undergraduate degree. Must be under 24. Again, none of the credit is refundable if the taxpayer of the claimant is under age 18 or 18 in a year, earned income was less than half of his own support, et cetera, et cetera. Again, students can claim the non-refundable part if they have the corresponding level of tax liability. Okay. Don't see that. Generally, the students we see are still being claimed by mom and dad. So a lifetime learning credit, okay, this covers undergraduate, graduate, and courses to acquire or improve job skills. So the max credit is 2,000 per tax year. So now there's 20% of qualified expenses. So the max is 2,000. And these is a non-refundable credit. So it's just going to reduce tax owed. Again, they must, just like the AFC, attend an eligible institution. Qualified expenses include tuition and fees, et cetera, et cetera. I don't know why it says really do books qualify for LLC. I don't understand that. That's an expense. Um, and they can be less than half time. This is generally, we see this for people who are in graduate school or maybe are taking a class online of some sort, which may generate a little bit of a tax credit. So again, generally it's pretty straightforward which credit to use. The problem is if they're in, let's just say they're starting at community college, so their expenses aren't that significant. We may not want to like use the American Opportunity Credit if their intention is down the road to transfer to Rutgers or wherever or four-year school where their expenses are going to be bigger and would generate a substantially larger credit. So this comes out of the 40/12. This kind of shows you the difference between the two. A lot of the things are the same as far as expenses and can't have a felony drug conviction and all this stuff. So I reference this every now and then when for some reason if I have a little bit of a question as to which credit they may be liable for. Okay, so this is what, in this case, this is kind of a typical tuition statement where box one shows that there were $9,900 in qualified expenses, but box five has 5,360 in scholarships or grants. So the net of that is 4,500. So right then and there, we don't have to worry about more expenses or anything. They're over the $4,000 limit. I mean, we see this too, where box one could be $25,000 and there's nothing in box five. Um, Whether it's 25,000 or 4,000, the max that you put into tax-wise is 4,000. Now here it's a little different. It's the opposite. Okay, so in this case, there is income greater than the payments that were received by the school. Now that's a fairly big jump. That's twice what the payments were. This is going to generate a taxable income situation. In all likelihood, this will go on the student's tax return because again, he received the money. Um, and if it was closer, let's just say there was like $5,500 in scholarship or grant, you could make the argument that that was, for $500, you bought books or paper supplies or something. It's when it gets to this kind of number that we see a problem. We had a woman last year who came into us from, I've been doing some not teaching, but maybe she was doing some research or something at Ryder, and she got a stipend in box five that was something like 25 or $30,000. And again, that had to go in as W-2 income with no tax withheld, and she had a balance due of like $3,000 or $4,000, which was news to her. But I mean, at the end of the day, again, would you rather pay that $3,000 or $4,000 to the IRS or worry about paying student loan equivalent of that for goodness knows how many years? Um, Again, the choice is generally very clear. Like this one here, it's greater than 4,000. Box eight is checked. He was more than at least a half-time student, so he's going to get the American Opportunity Credit. And that's usually how black and white it is. Okay, when the student is a dependent, whenever possible, the best option is to have the parents and the student coming together to get their returns prepared. Not only as far as figuring out what the credits might be and how it might work out, but the other thing is to make sure that the student doesn't file a tax return and indicate that mom or dad can claim him, because that's a big problem. We've had several of those this year. It takes a while to change all that. And again, it's usually an error on the student's part. Had a summer job, went online, thought he was going to do a free file through TurboTax or something, and yeah, he got his refund. But now, because of something he didn't do, mom and dad can't claim him. They got a paper file with a letter saying blah blah blah, and that's going to take months, if not many months, to sort out. Again, scholarship again, credit, if any, is claimed by the taxpayer who claims the dependent. Remember, they're going to get that $1,500 part of the non-refundable credit, which should help them lower their tax liability, as well as the $1,000 refundable credit. Again, but if there's anything above expenses, the income goes on the student's tax return. Um, Again, it's not income of the person who claims the dependent. And again, because most of the dependents have very little or no income, chances are there's not going to be a tax liability. Now, if they had another job, let's say they were again, we had a woman a couple of years ago who was working full time and had a fairly large grant or scholarship, um, it actually indicated that she was probably due to pay the kiddie tax, which is mom or dad's tax rate, which at that point she didn't want to file. So, who knows what happened there. Again, filing the kiddie tax is something, it could be a problem, but we don't see that. It's kind of out of scope. Again, this is just kind of recapping some of the same things I've gone over as far as um, maximizing the amount of the credit. Again, making sure that if you can get the expenses to 4,000, that's going to help them the most. If they're in a 4-year college situation, they're more than half time. It's almost always going to make sense to go for the American Opportunity Credit. Lifetime learning is generally grad school or people that are just taking a bookkeeping class because they think it might help them get a promotion at work, something like that. Okay, that's that. I just want to spend a few moments here before I wrap up on two things. This is what the 1095A looks like from the health insurance marketplace. So it's going to have the marketplace identifier, the name, when the policy started, when it stopped, all this stuff we have to enter into tax-wise. If there are other covered individuals, and then they're going to indicate here the amounts, the monthly enrollment premiums, the second lowest cost plan, and the actual monthly premium tax credit. Usually it's the same for all 12 months, but if for some reason during the middle of the year, maybe they change plans, maybe they found a bit cheaper plan or something, that could change. They could also get multiple 1095As because of a variety of reasons. And the important thing is that we have to have them all. If they indicate, even if they only had 1 month, they have to have this because the IRS will reject the return if they have an indication from the insurance company that this individual had purchased insurance through the marketplace. So again, that's something we've tried to put in everybody's client notes in tax wise. If they had health insurance through the marketplace in for 2023, that we make sure we answer the question for 2024. And again, if they don't have it, they're going to have to come back. Getting on, I mean, some of them may be sharp enough to go online and get it through the insurance company. They should have an account through the insurance company, which there is always a part for tax documents, which is what this is. And then I just want to bounce through and trying to kind of work in some of what I've kind of droned on about for an hour and 4 minutes. With some of the questions on the basic exam. So in basic scenario 3, this is Felix and Gabriella. They are and they filed married jointly. There's their wages. They have 2 kids. Helena is 12 and Juan is 16. They're all U.S. citizens. They all have valid Social Security numbers. They've all lived the U.S. for the same year, the entire year. That's a home run there. Okay, no worries. They're going to qualify for everything. So which one qualifies for the child tax credit? Pretty straightforward, okay? And then number 6, again, when you go through this, when you're actually doing the test, because I can't really give you the answers, but I would focus on some things that could trip you up, which is question 6. The Garcias can claim a maximum refundable additional child tax credit because we're talking 2 different credits here, which is very important to keep in mind when you kind of go through all this. And then there's just one more. So here's Kevin and Ella. Kevin, they want to file a joint return. Kevin is a resident alien with an ITIN. Ella she has a social. So they have one each. And they have 2 kids, age 11 and 19. Okay. And let's see here. And okay, so the kids, they both have socials. So do they qualify for the credit for other dependents? I think we went through that pretty obviously. Okay. It says they qualify for the earned income credit, even though Kevin has an ITIN. Well, I think we kind of answered that when we went through the material as well. So that's just kind of something I want to kind of leave you with, a little something that we try and build on. There are more questions with similar on the basic test as you go through here. Here's Kendall. It's 63. Okay, remember 63, et cetera, et cetera. I'm going to stop it right now, the recording. And that will do it for these 4 sessions.